Hi, I'm Duarte Caldas, investment principal of Tricoma Capital. My background has been always financial markets. Last 10-12 years I've worked in energy, mainly power and gas. And recently, 4 years ago, I changed to asset management again, starting this project with Tricoma Capital. And I'd like to thank the invitation to talk about the Portuguese economy. So it's my pleasure to be here. Portugal economy basically just keeps performing. Government accounts are balanced, external figures remain robust, the domestic economy has a real momentum, especially because wages are rising faster than inflation. Average salaries are up 6% year on year. Inflation is about 2.6, 2.7%, so real wages are growing over 3%, and that's feeding directly into consumption, and it's noticed on the Portuguese economy. We're also beginning to see the first signs of support from lower interest rates from the European Central Bank, which is helping households refinance and unlock spending power. Tourism continues to outperform, completely exceeding expectations. Overnight stays are up more than 7% year on year, and revenues from travel services are over also 7% of GDP. So it's no surprise that S&P ratings agency has recently upgraded Portugal to A+, and even more telling, its bond investors and the markets are recognizing these improvements and this growing confidence. The 10-year spread to Germany is down about to 45 basis points. That's lower than Spain or France, for example. And we're talking about levels that were not seen in over a decade. Let's talk about debt, for example. In recent years, Portugal has made remarkable progress reducing its debt burden to GDP. So at the peak at COVID, around 2020, Portugal had a debt to GDP ratio of around 130%, slightly above that. Since then, it's been coming down on a sustainable basis, and we have noticed remarkable progress. So by 2022, it was around 112%, 2023, 97%, and last year, it's estimated to be around 94, 95%. That's 40 percentage point drop in just 5 years. So it's one of the fastest improvements in Europe. In absolute terms, the public debt is still around 290 billion euros. That's roughly 98% of GDP, reminding us that the nominal stock is still growing, right, in absolute terms. But basically, investors recognize that the Portuguese economy is growing and are rewarding the Portuguese debt accordingly. Let's talk about the labor market. The labor market remains extremely strong. The unemployment rate is at record low levels, around 5.8, 6%. It's the lowest in 2 decades. Employment is growing about 4% year on year. Portugal has now a record of over 5 million people, more precisely 5.1 million people employed. The inactive population continues to reduce. And this tight job market, together with rising real wages, so wages are rising above inflation, keeps supporting domestic demand and keeps supporting consumption. So with inflation contained between 2.5% to 2.8%, broadly aligned with the European Central Bank target, although services prices are under some pressure, as in the Eurozone and in the US as well, in the US economy. But even so, GDP is growing around 2% year on year, in the second quarter, compared with just 0.7% for the Eurozone. Leading indicators are suggesting that momentum is still continuing into this Q3, the third quarter. Retail sales are up above 7%. Electricity consumption as well. So we are talking about 3% growth on electricity consumption year on year. Portugal has made a remarkable progress with renewables as well. So in short, Portugal is quietly becoming one of the euro area's strongest performers. We have faster growth, lower unemployment, improving debt dynamics, and a clear vote of confidence from international investors. So it's a country that, after years of adjustment, now combines the fiscal discipline with genuine economic vitality.